Okay, everyone, welcome to the 2025 annual edition of Roundtable Prime here from the DoubleLine offices. We have our 4 returning champions plus our CEO today along with us, and we're going to cover everything about markets, macro, some ideas, and who knows where it'll take us with this diverse panel today. So thanks, everyone, for joining. I'm going to give a brief introduction of each of our guests, but as I said, they're all returning champions. To my left to start, this is Jim Bianco. He is the founder and president of Bianco Research. Pretty easy to remember, right? Today we use that to pivot into what's going on in the macroeconomic environment. And I think probably one of the more prominent themes over the last couple of years, and since it seems to create a lot of divisiveness still today, is the path of inflation. So I'd like to start off with you, Jim. You've been kind of vocal about a higher structural inflation for a period of time. I won't get into your reasoning. I'll let you talk about all of that. But where do you see inflation heading this year? And let's talk both, from a CPI perspective and the Fed's favorite measure of core PCE. And do you think the Fed will achieve their target this year? If so, why? And if not, why not?
Well, let's start with CPI. I'll start with core CPI, ex food and energy. It's 53 months now. It's been about 3%. So that measure is not getting towards the Fed's target. And all the measures of inflation, the November number is the last number that we've gotten. We'll get December a couple of days after this recording, is higher on a year-over-year basis than it was in May. And that's the longest we've gone since the 2022 peak without it continuing to make a new low. So it looks like what I'm trying to describe is inflation is bottoming out at levels unacceptably high for the Fed. If you use the PCE measures, you're talking about the mid 2s to the high 2s, CPI, as I said, in the low 3s. I've been of the opinion that the inflation rate is now a 3 to 4% inflation rate. And depending on which measure you're using, that's about where we are right now, around 3%. And that this is the world we have right now in terms of inflation. Why? I mean, we can get into that with the rest of the panel as we go through, but really quickly, I would just say that I still would argue from the bigger picture, 2020 was a secular change, that the disinflation of the 40 years that we saw, the disinflation that brought about lower and lower interest rates, turned the tide with the shutdown restart of the global economy. And now coming out of it, we're in a 3% inflation world. We're not in an 8, 9, 10 or Zimbabwe inflation world, but still, if we're in a 3% inflation world and we are going to see positive real yields, meaning interest rates above the inflation rate, we're talking about a 4 or 5% interest rate world as being fairly normal, as opposed to when are rates going to come down? Maybe this is where they should be.
Yeah. Well, Jeffrey.
Yeah. Can I jump in on Bob Gordon, who's a professor at Northwestern University, has written a lot about tech innovation. And he's talked about that tech innovation historically has always been a net creator of jobs. So the problem with innovation is we can see the jobs that are going to be replaced. It's, as you point out, 60% of the jobs that we will have in 30 years don't exist now. It might even be higher than that. And we don't know what those jobs are. Right. And, just like the example that he uses, you hold up your phone in 2007, here's Steve Jobs with the iPhone 1. Raise your hand if you said that's the end of the hotel business. That's going to forever change the taxi business. You didn't foresee Airbnb and Uber, but those are the types of things that technology unleashes. So, yeah, what's going to happen with the economy is we're going to see a fundamental change in the economy. I liked, Brian Moynihan at the Bank of America. He talks about that they're spending more money on technology and AI than any other bank. But I always wonder, because he seems to think that Bank of America's business model is going to stay exactly the same way it is. We're just going to import some computers and we're going to replace some middle management people, make it more efficient. We're going to change the entire business model of how this stuff works. Probably starting with Moynihan's job, but maybe that's the uncomfortable part. So what this technology is going to do is it's going to forever change what we did. The last thing I would give you is the internet itself. When it first came in, one of the first casualties of it was the newspaper business. We created, the internet and blogs and now Substack, and then we went after broadcast and we've got YouTube and everything else. but look at the influence and the power and the jobs that they've created. So this technology is going to be a net plus. But I agree with you. Getting from here to where we're going to be is going to be a bumpy road.
But you could say,
Can I throw a question at you, and maybe anybody else wants to answer it? In Trump season 1, we had the line that you need to take him seriously, but not literally. And now we've got Trump talking about Greenland and Canada and Panama and, all this other stuff. Should we remember that line that we should be taking him seriously? When he talks about Greenland, he's really talking about a security threat that he wants to get rid of more so than, having it with a running gun battle with Canada to be the 51st.
I would say on a scale of 1 to 10, Panama is a 10. He wants Panama. He wants the Panama Canal, rather.
I understand that because there's an asset there that, quite frankly, is not being managed very well, and it does impact us. And it used to be our asset to begin with, and that needs to be fixed. But does he want the Panama Canal fixed? Does he want Greenland security to be solved, or does he want those?
I would say, if he could buy Greenland, he tried to buy Greenland for $100 million, right? At one point, and they rejected the offer like 60 years ago. But
maybe that's where Doge comes in. Dogecoin, right? He can use that to buy it.
Yeah, we'll mess it up for you.
The beauty of Trump is that he speaks, and this is what you're saying, and I guess I'm sort of agreeing with where you're going with that. He speaks in metaphors, and that's actually why he connects with people. The career politicians, they think that the way you connect with people is you give them all this down in the weeds, you have tremendous command of specificity and all this stuff, and then they mock Trump because he exaggerates everything. The figures he gives tend to be loose, but they're not seeing what's really going on. He's speaking in a way where people like the direction of the metaphor, and I agree that Panama is probably a 10. Greenland, I think is we've been here before.
Yeah,
I mean, this immense tariffs on Denmark. I don't think that's going to happen. I don't think it would have any effect.
What is it? Pickled herring that we?
Yeah, right.
Well, Prime 2025 from DoubleLine's offices here in Los Angeles. This is segment 2, where we're going to talk more market implications of the previous discussion.
That's the idea.
Yeah. So, Jim, you brought up the idea of a structural change of inflation. Jeffrey's talking about a steepening yield curve. Isn't it also rational to think that the yield curve should steepen if indeed we have higher policy rates, right? If that higher inflation leads to a higher policy rate, and in normal times we should command a term premium, right? Wouldn't you expect that to be some of the driver from your seat as well?
Yeah, I mean,
I'm not trying to put words in your mouth, but
no, yes, I mean, what we're talking about is a bear steepener in the yield curve. A bear steepener means the yield curve steepens in the face of higher interest rates, and it's uninverted via the long rates going above the short rates, and that is somewhat unusual for the yield curve to uninvert and steepen that way. Normally, it steepens in a falling rate environment with short-term rates falling faster because the Fed is panicking that the economy is weakening and going into recession, not with rates rising and long rates rising faster. That, to me, has been an inflation trade, is that we're putting in, with rising term premiums and bigger real rates, we're putting into the markets more risk of potential inflation. And that gets to what Jeff said in the first session, that what we've seen happen since the middle of September when the Fed cut 50 basis points is the 10-year yield has gone up 100 basis points while they've cut 100, and that there isn't really any examples, or maybe 1981 when they came off of 20% and long-term yields went up, and Ed Yardeni coined the term bond market vigilante to basically describe that period. That might be the only example that we've got of what we're seeing with this divergence in rates. I think it's all about the idea about, or the fear of inflation. Maybe it doesn't manifest, but it is definitely a fear, which is why you've got this bear steepener. And what's driving that? The idea that the economy, 9 of the last 10 quarters, has grown at least 2.5% top line. Yes, it's a K-shaped economy. Yes, underneath there's a lot of issues, but the top line is growing at 2.5%. That's above its potential, meaning that it's fully, that's what you should expect out of the economy.
Well, like during the post GFC to the pandemic, I think it was like 2.3% was the annualized growth rate over that period.
Right. And now we've
So
got.
that's why you talk about above potential.
Right. Above potential. So now we've got like 9 of the last 10 quarters that are above that. Now we got Trump coming. And I know we're not trying to be obsessive about Trump, but that's fiscal stimulus, that's tax cuts. That's going to put a tailwind to the economy. Then you throw in the Fed is cutting rates. The market's going, wait, we don't need this. We got enough already. All this is going to do is produce fears of inflation. And you see that in shorter term tips inflation break-even spreads at 2-year and the 5-year tenors that they're moving up. And that's why the more they talk about cutting rates, the higher long-term rates are going to go. And I think that that's really what we've got. You add it all up, and we've got this unusual situation of the bear steepener with rates going up and long rates going up faster.
So, Jim, as you think through all this too, I started off with, kind of talking about the bond market here. What are you thinking about on the stock side? What are you liking on that side of the equation? And, also you write a lot about gold and things as well. Gold had a great year last year as well, right?
Yeah. I'll start with the first part of your question with the stock market and riff off of something Charles said about that we could be poised for decades of prosperity coming forward. In something that I said earlier, when technology comes, it isn't, here's my business model. This is the way that our business works. Now we'll just unplug these middle management people and we'll stick a computer in and our margins will go up and everything is going to be great. We're going to have to redefine all these business models. And in that process of redefining all these business models is that prosperity that we're going to come. We're going to make businesses work in ways that were not possible, that we haven't thought of. And a lot of that is going to continue to come forward from here. And that's both, exciting and scary at the same time, because it's the Schumpeter creative destruction is what we're talking about. And that's what leads you to a period of decades of prosperity if you allow it to happen. When you start in on, no, we have to have inferior chips, you're protecting the status quo. That's when you have decades of stagnation. And hopefully we're getting away from that and we're going to have those periods of prosperity. As far as the stock market goes, I'll say this about the stock market. It's about expectations. And what worries me a bit about the stock market is not that it'll go down, not that you're going to lose a lot of money, but that we have unrealistic expectations that everybody's kind of caught this, I call it the FOMO bubble, right? That something is going to go up 50% this year. A big idea is going to go up 50. What is it? And how do I play it? Because there's always a 50% idea. Well, what about if the markets are going to give you 6 or 7 or 8%? And if I'm right, and we're in a 3% world, and you could keep churning out 6 or 7%, no. I want the 50% idea. I want the 25% idea. To what you asked me before, last year gold was up 25% for the year, and the S&P was up 25% for the year. That is the first time ever both of those returned more than 25% in the same year.
And most people don't realize that gold did it, except the gold bug folks, right?
Right.
You would never, you could win that bet in a bar.
So you've got everybody going, yeah, because so many things go up 25%. Now, I'm talking not individual stocks. I'm talking like sector kind of ideas. So yeah, there's all kind of things that are supposed to go up that much. So what I'm afraid of with the stock market is this expectations game that, yes, you can continue to make money. Yes, you can continue to make money on a real basis, well above the inflation rate. But are you going to double your money every 3 years? That's effectively what a 20 or 30% gain is. No, you shouldn't be expecting that unless you're going to micro ideas of a particular stock or a narrow sector. But if you're waiting for asset classes to keep doubling every 2 or 3 years, I think that that's going to be, where the disappointment could come in. And if it continues, then you get into real overvaluation areas, and then you could be, poised for some kind of a pullback in the markets.
You're referencing the survey of consumers. Do you expect significant gains in stocks over the next 12 months? It's like 60% higher than the previous.
Right. That record conference board.
Well, the other one, though, the
Yeah, no, this is
AAII, the
New York
American
Fed.
Association of Individual Investors, Ironically, that's come down a lot. It was 50 in October, and now it's below the historic average. It's like 33%. And that's a weekly survey. So
it's super noisy though, too, right? In fairness,
it's been orderly. That in the last couple of years, it's been really right. I mean, it's the CIO, the investment folks who seem, the professionals who seem a little bit more exuberant than normal to me. That, I mean, my worry is the rotation trade. I love the rotation trade. It's a lot, hey, I can make money at 493 stocks. It makes it a lot easier. I want the rotation trade to kick in, but so far it hasn't. To your point, in part, I think, Jim, because people are like, listen, we could hit these grand slams right now.
Right, and they're kind of ignoring it. And on the rotation trade, I think that the companies that are not Google or Meta or Apple or NVIDIA that are making AI, you're saying, oh, what does it mean for our company that AI is coming? Start with, how do we structure our business? What is our business model supposed to be in this environment? Like I said, I can't emphasize enough that this mentality is, oh, I'm going to buy this computer and I'm going to fire these 3 people and the computer's going to do their job, and that's what AI means. No, it's way, way more than that. And it's both scary and really opportunistic at the same time.
Well, AI is just a massively high-dimensional correlation matrix. It's really what it is. So to distill it down, you brought up 2 25%ers of broad asset classes. The China large cap ETF, which is, it invests in large cap in China, obviously. It was up over 30% last year with all of the ramifications of what's going on in China. Usually people have very strong opinions about investing in China. Where do you guys sit today? And that's a jump ball for anyone.
I'll jump in on that one. What happened with China was, until September, it was a giant horror show. China was a sophisticated way to continue to lose money. Then the Chinese government panicked. They announced what seemed to be like a stimulus program a day. And they cut rates, they printed money, they even talked about the idea of a low-tech helicopter. What I mean by low-tech helicopter was they were going to deploy government workers with wads of yuan, their currency, to hand to homeless people so they could spend money to get the economy going. I was like, it's more efficient if you just throw it out of a helicopter.
You were trying to draw the parallel to helicopter money.
Yeah,
right?
exactly.
Vietnam.
Exactly.
Yeah.
Then their market went up something like 25 or 30% in 10 days, right at the end of September, and hasn't done anything since. Meanwhile, their bond market yields are collapsing to the lowest levels that we've seen. As I mentioned, their stock market has stopped going up. Their economy's GDP is, if you take out the periods of COVID and Tiananmen Square, if you take those 2 periods out, they've got the lowest levels of GDP growth in 50 years right now. And Wall Street thinks next year will be lower and 26 will be even lower. I talked about creative destruction. I talked about that, you've got all of these changes coming. China's the opposite of that. They refuse to change. They refuse to put in any kind of a potential policy that would allow any kind of creative destruction. And I think it's catching up with them. And the answer is, well, if we just throw money at it, even that isn't working. The bazookas that they kept firing to try and get their economy going just excited David Tepper and a bunch of hedge fund managers for about 2 weeks that bought their stocks, and then it kind of ended right there.
Well, and on top of that, it's like, okay, well, I don't take enough risk, so let's just do it. It's blind. I don't want to hear about it. But I got to say, I was amazed. In 22, my bonds were down a lot. My stocks were down a lot. But my private credit, my private equity, it was flat to up.
Yeah.
So, I mean, it's a brilliant investment. With
like a CD doesn't have a price change either.
That's right. You're just hoping it matures. But the problem is you will have a markdown at some point. It just will be minus 100.
But now we've got private credit is now starting to roll out ETFs.
So How is that possible?
We've gone from the accredited, qualified investor to accredited investor to John Q. Public. So what's Apollo keeping and what's Apollo putting in the ETF that they're giving the John Q. Public is really, and what I think has happened largely with the alt space is this is an outgrowth of Dodd-Frank for 15 years ago, which is why we've seen the number of IPOs go down and everything else, that they've made it so disadvantaged to be a public company and so disadvantaged to raise public money that we're just bypassing that space and we're raising private money. and we're doing this in private kind of ways. And then it now takes on the point, which is what I was kind of implying with the private credit ETFs, that going public, whether it's an ETF or it's an IPO of a company, is like an exit strategy. In other words, you are my exit liquidity. And I am making this determination that this thing is now run its course. You can have it and good luck. I'm going to walk away from it right now. That wasn't the case before. That wasn't the case if you go back in the 80s and the 90s. When the Googles and when the the Microsofts and stuff came public, they were very early stage companies. And when Amazon came public, there was still 1,000x left for the public to make in those. Now the 1,000x is made privately, and then they give it to the public after that. That's the problem with the alt space right now, is to try and figure out what are they pitching me to be their exit liquidity on versus what are they pitching me that's in the earlier stages of that. And just to give you one kind of mindset idea, that was the popularity of SPACs for a minute. And what was a SPAC before they kind of blew up was, I want to get in before the IPO. I want to get in a little bit earlier so I can enjoy some of that 1,000x move before we hand it off to the public. And so the SPAC was an idea to try and get in early. But then they turned that into exit liquidity too. And then that wound up being
There's
bad.
still one that's pretty good. All right, welcome back to part 3 of the 2025 annual Roundtable Prime here at DoubleLine. Today, what we're going to finish up the segments with is lessons learned in 2024. Hopefully, everybody learned something this year. And secondly, what the best idea is for 2025. So let's start with lessons learned. Jim?
Momentum. And I want to talk about momentum in a couple of ways that's been mentioned before. A lot of people in the investment business, we go to fancy schools, we get fancy degrees, we have sophisticated theories, but at the end of the day, we're all momentum investors. If it's going up, we get all excited and it's going to keep going up. And when it's going down, all hope is all lost and it's going to be all over. And let me throw in one other parallel to that. We are ruled by DraftKings and FanDuel. We are a gambling culture that would make the Chinese blush at this point, the way that we continue to gamble and how
it's sad in sports now. You can't
Yeah,
watch
it's
a sport
ruining-
event without
it's-
giving you live updates on live.
it's ruining sports and all that other stuff. But that's a whole nother section that we need to have after this. And because of that, I think what I've learned again in 24 is, because we're so driven by momentum in gambling, every trend is going to go way further than I ever think it's going to go. Both directions is where it's going to wind up being. And that we seem to be whether boom bust. And it might even transcend just financial markets and kind of the way that we think about a lot of things, that we overdo it. Look at the election, right? It's always the greatest election of our life, and human history is on the ballot and all of this other stuff. And it rarely ever is at the end of the day. I managed to say that without using the T word. And so I think that, as far as momentum goes, that's going to be the thing that I want to focus on, is that if the markets are going to be boom and bust and I want to be sane, I think what I want to do is I want to try and focus on where I should be investing longer term. And I kind of hinted at this before. If you look at valuation, Rosie says it's not a timing tool. Absolutely, it was never meant to be a timing tool. It's a good expectations tool. Look at valuations and says, what should I expect this investment to do over the next several years? And I hinted at this before. I think in the bond market, you could be probably looking at a 5-ish% nominal return in the bond market. In the stock market, maybe a 6% or 7% nominal return. The stock market is going to give you more risk. It's going to be a bigger thrill ride. The bond market will have a little bit more less volatility. But what's changed now that we haven't seen in the last 20 years, if what I'm right, I just described a bond market that can compete. Before, the old 60-40 portfolio, which was 60% stocks, The 40% bonds was crash insurance. You were supposed to buy these things in case the stock market blew up, and then the bond market would rally and offset your gains. Well, that didn't work in 22. But I think what we're talking about is I want to churn out investments more than the idea of inflation. And if I could beat inflation by 2, 3, or 4%, I'll be happy with that. And yes, there will be years like 24 where Bitcoin's up 120% and gold and the S&P's up 25%. And everybody's asking me, what is the next grand slam? Because it's all I care about. Because there's always a grand slam. And if at that point, that will continue until it doesn't, and then everything will go down and all hope is lost. And if I want to churn out throughout all of that while the world is doing this, I think I'd be very happy at the end of the day. Now, how do I want to invest? I'll give you one last thought about investing. DoubleLine did not pay me to say this, what I'm about to say. In investing, passive versus active, the data shows that it is very difficult for an active manager to beat a benchmark in the equity market. Why? Because of some of the things we just talked about. You have to be fully invested in all of the all-stars. You have to be fully invested in NVIDIA and the Mag 7. And if you're not, and usually you're not because the CFA taught you that these are overvalued and risky companies and you shouldn't have 35 or 40% of your money in it, you underperform. But the active passive data in fixed income is very different. The index usually comes in around the 50th percentile, not the 95th percentile like it does in equities. And active management in fixed income is a better way to go. And it solves the question that a lot of investors ask me. Okay, if you tell them buy AI, buy generative technologies, buy energy, buy broad-based measure stocks, they all nod their head. They nod their head. What should I do in fixed income? And if you start talking to them about, well, if you thought about structure, if you thought about, corporate bonds, or if you thought about asset back, their eyes glaze over. You have no idea what they're talking about. Give it to a competent active manager is what you should do in fixed, and look for passive kind of themes or passive investing ideas in equities.